Welcome to the deep dive. We're tackling a fascinating case study today, J.R. East.
Ah, yes. Big one.
Huge. Most of us probably know them as, well, the massive railway operator in eastern Japan. The veins of that region, really.
Absolutely. Hard to miss them.
But what might surprise you is how this company has really expanded its reach, far beyond just tracks and trains.
Definitely.
We've got their latest integrated report right here, and our mission today is to sort of cut through the noise, understand their core business strategy, their financial muscle, and, where they see themselves heading.
Exactly. And it's not just about moving people from A to B anymore. Not
Ye-
by a long shot.
Right.
Their report really emphasizes this dual engine for growth. They call it mobility and lifestyle solutions.
Okay.
It's a fascinating pivot, really, for a company with such a long history in a, well, very traditional industry.
It makes you wonder, how does a railway giant like that reimagine itself for the future?
That's the key question, isn't it?
Okay, so mobility.
That makes intuitive sense for a train company, obviously.
But they're framing it as a technological service business. What's the nuance there? It sounds like more than just running trains on time.
Yeah, you've hit on a key point there. The emphasis is really on leveraging technology, enhancing and evolving their core railway operations.
Yes.
Well, think about it. They're not just maintaining existing services, they're actively innovating. We're seeing things like new, more comfortable seating options on limited express lines.
Nicer seats, always good.
Definitely. And bringing green cars, those premium carriages, to the Chuo Rapid Line. That's a big deal for commuters,
Improves the daily grind a bit.
hopefully. And then there are the really ambitious projects, like advancing driverless operation tech for the Shinkansen.
Whoa, driverless bullet trains.
Yeah.
Seriously.
That's the plan they're working on. It's a significant technological leap. Huge implications for efficiency and potentially safety down the line.
That's certainly a headline grabber. But beyond the passenger experience, where else is this tech push happening in mobility?
Oh, crucially, it's also about streamlining their operations. Behind-the-scenes stuff.
Like maintenance.
Exactly. They're introducing new tech aimed at reducing the labor needed for essential things, like infrastructure inspection and construction, things you don't always see.
Okay, that makes sense.
And given the demographic challenges Japan faces
Yeah.
with the shrinking working age population.
Right, the labor shortage.
Precisely. This focus on labor-saving tech isn't just about efficiency. It's about the long-term sustainability of their operations. It's almost a necessity.
That clicks when you put it in that broader context. Now, I noticed some interesting moves related to commuter passes, encouraging off-peak travel. What's the thinking there?
Yeah, that's a smart strategic play, I think. Starting later this year, they're significantly boosting the discount for off-peak commuter passes,
How much?
up to 15%, and creating a wider price gap compared to the regular peak time passes.
Okay, so a real incentive.
Yeah. The underlying logic connects to how companies are adapting work arrangements, flexible hours, that sort of thing.
Right, less rigid 9 to 5.
Exactly. So by incentivizing commuters and maybe nudging their employers to shift travel to less congested times,
They spread the load.
they hope to optimize network utilization. Yeah.
Yeah.
Reduce strain during peak hours, make the whole system more efficient.
So managing demand, potentially unlocking capacity without having to build loads more track.
That seems to be the idea.
Hmm.
But of course, running a railway isn't without its hurdles. What are the main headwinds they're acknowledging?
Yeah, they must face some challenges.
They're pretty upfront about them. The declining customer base, because of Japan's demographics, that's a big one, and the tight labor market.
Costs too, I imagine.
Yep, rising costs for materials and labor definitely put pressure on the bottom line. But on the flip side, they also see big opportunities,
Like what?
particularly the continued surge in inbound tourism. That's expected to keep growing, and it's a high-yield segment for them.
Tourist spending money.
Right. They also project commuter revenues stabilizing after the pandemic dip, and more growth in non-commuter revenues, like leisure travel.
Makes sense.
And interestingly, there's strong demand for, modification work on their existing train fleets, upgrades and refurbs.
Okay. To manage all this complexity, they must have some pretty sophisticated ways of measuring performance. I saw something called ROAR. What's that?
ROAR. It stands for Return on Assets for the Railway Business.
Okay.
What's particularly insightful here is their use of EBITDA earnings before interest, taxes, depreciation, and amortization as the numerator.
Instead of just operating income, why?
Well, for a capital-heavy business like a railway, EBITDA gives a clearer picture of the core operational cash generation before big non-cash items like depreciation.
Right, which can be affected by accounting choices.
Exactly. The denominator is their fixed assets in the railway segment. They even use something called ROAR tree to break this down.
Agree.
Yeah, it maps out the core drivers: revenue, cost, capital investment, asset turnover, how efficiently they're using their stuff.
Very detailed.
And what's fascinating is they set EBITDA-based KPIs, these performance indicators, at both the headquarters level and for individual branch offices.
So it cascades down.
Creates a very direct line of sight to operational performance right down the chain.
So a very granular approach within the railway side. What about measuring success even more locally? Like town by town?
That's where their area management system comes in. This is designed to quantify the impact of specific things: revenue-boosting efforts, cost-cutting measures at a local level.
Bringing different teams together.
Yeah, different operational units within a particular area. By making the results visible with actual numbers, they're encouraging a bottom-up approach to improving value.
Empowering local teams.
Exactly. Letting them identify and implement improvements in their own patch.
Okay, we've dug pretty deep into mobility. Let's switch tracks now to lifestyle solutions. This seems much broader, maybe less obvious for a train company.
It is broader, yeah, but it's absolutely crucial to their strategy. Diversifying, tapping into new revenue streams.
How does it work?
The core idea is transforming stations from just places you pass through into, well, comprehensive service centers.
The Ekinaka concept inside the station.
That's the one. Think of all the retail spaces, restaurants, cafes, other services you find packed into Japanese train stations.
Right, they're like mini malls sometimes.
Exactly. It caters to the daily needs of commuters, local residents, everyone.
And a key part of that ecosystem seems to be the Suica card. It's way more than just a ticket, right?
Oh, absolutely.
Yeah.
Suica started as a convenient IC card for fares, but it's evolved. It's a leading platform now for a huge range of lifestyle services.
Beyond just transport and payments.
Yeah. Their ambition is to build a whole SUIC economic zone, leveraging its massive user base for everything from shopping to accessing local services, loyalty programs.
Wow, like a digital key?
Sort of. Imagine it becoming your go-to digital key for daily life in Eastern Japan. That builds incredible customer loyalty.
And gives them loads of data, I bet.
Valuable insights into consumer behavior, definitely.
So they're thinking beyond just the people in the stations, thinking about the wider communities.
Precisely. They recognize the need to reach beyond the station walls, engage with a wider customer base in their daily lives.
And what falls under this lifestyle solutions umbrella?
Several key areas. Retail and services, that's everything from convenience stores to restaurants. Then there's real estate and hotels.
Leveraging their land.
Big time. And crucially, IT and Suica, which is kind of the engine driving a lot of this expansion.
The real estate bit makes a lot of sense. They must own tons of land around stations. How are they managing that?
They're taking a consolidated, group-wide approach to optimizing those assets.
Meaning?
Well, things like repurposing underused company housing sites. And they're actively doing what they call a real estate rotation business.
Rotation, like selling and buying.
Kind of strategically selling properties, often to REITs or other funds, to realize profits quickly, and then reinvesting that capital into areas with higher growth potential or developing new properties that fit their lifestyle strategy. Smart asset management.
And the move into finance. JRE Bank. How does that fit in?
JRE Bank is a really interesting initiative. It's designed to deepen customer engagement across the whole JRE's group.
Not just a regular bank, then.
No, it offers benefits beyond traditional banking.
Right.
Things like exclusive discount coupons for JRE's trains, special offers at their hotels.
Ah, so it loops back.
Exactly. The idea is to incentivize customers to use a wider range of JRE services, create synergy across the different business units.
It all sounds very interconnected. What about the role of digital tech in enabling all this? Data and AI.
It's absolutely central. Couldn't do it without it. They set up the Digital and Data Innovation Center in October 2023 specifically for this.
To do what exactly?
Harness the power of digital tech and data, adopting agile development, setting up robust governance for data and AI use.
Are we seeing results yet?
Yeah, some tangible things already, like a generative AI-powered document search system they're using internally, and the Docator Dial interactive voice response service for customer queries.
Improving efficiency and service.
That's the goal.
It seems like a key underlying theme here across both mobility and lifestyle is integration. Collaboration between all these different parts.
That's a critical takeaway, absolutely. They explicitly state how important group-wide integration and collaboration are across all segments, all job functions.
Why?
They see it as essential for creating new value, leveraging the combined strengths of the whole JRE's group in this, evolving landscape. Can't operate in silos anymore.
Okay, let's pivot slightly. Let's talk money. The financial health of the company. What were the highlights for FY 2024? That finished in March, right?
Correct. Ended March 31st, 2024. And yeah, showed a positive trajectory. Their third consecutive year of revenue growth.
Nice. Which parts did well?
Notably, transportation, retail and services, and their others segment all saw increases in both revenue and operating income.
Good growth across the board then.
Mostly. The real estate and hotel segment also grew revenue, but operating income dipped slightly. Although,
yes.
if you exclude the impact of real estate sales from the figures, both revenue and income actually grew in that segment too. So the underlying business was strong.
Gotcha. And what drove this overall performance? Any specific factors?
They specifically highlighted the success of their demand stimulation initiatives, things like that. Let's travel on weekdays. Early booking discount pass.
Pushing off peak travel again?
Yep. And also their enhanced efforts to cater to the increasing number of visitors to Japan. International travel rebounding really helped.
Okay, let's get into some hard numbers. What were the key financial metrics for FY 2024? Give us the rundown.
Okay, let's see. Operating revenues hit $2,730,119 million. It's about quite a lot.
Hefty number. And profit.
Operating income came in at a healthy $345,162 million. Net income attributable to the parent company owners was $182,909 million.
Solid bottom line. What about the balance sheet? Assets, debt.
Right. As of March 31st, 2024, total assets stood just over 10 trillion yen. 10,003,274 million. Total equity was 2,780,073 million.
And cash flow. How much cash are they generating?
Cash flows from operating activities were strong at 688,104 million. They did spend quite a bit on capital expenditures, though.
Investments in trains, tracks, tech.
Presumably. CapEx totaled 713,712 million for the year.
So spending slightly more than they generated from operations in that period.
Looks like it for that specific year, yeah. Some key ratios. Equity ratio was 27.8%, and their net interest-bearing debt to EBITDA ratio was 6.2 times.
How does that debt level sit?
It's something they're definitely managing. We'll get to their targets later. The report didn't break out free cash flow directly, but you can see strong operating cash generation even with those significant investments.
So overall, a pretty positive financial picture. Increasing revenues, decent profitability.
Generally, yes. Driven, as we said, by that rebound in demand domestic leisure, but especially international tourism.
And the lifestyle stuff.
The strength in retail and services also contributed significantly. That suggests the Ekonaka strategy is paying off.
Now, what about shareholders? How do they plan to deliver value back to the people who own the stock? Always key for investors.
They've set out clear targets for fiscal 2028, specifically on shareholder returns.
That does.
They're aiming for a total return ratio of 40%. That includes dividends and potentially buybacks, and a specific dividend payout ratio target of 30%.
Those are pretty solid commitments. Returning a good chunk of profit.
Yeah, it's a strong signal to the market.
And didn't they also do a stock split recently?
They did. A 3-for-1 split, effective April 1st, 2024.
What's the point of that usually?
Typically makes the stock more accessible, especially to individual retail investors, by lowering the price per share. Doesn't change the company's value, just chops the shares into smaller pieces.
Makes sense.
They also make a point of emphasizing ongoing dialogue with shareholders and investors, building long-term trust, enhancing corporate value, standard good practice.
Okay, looking ahead then, how are they positioning the business for the future? What are the big targets?
They've set some ambitious overall targets for fiscal 2028,
Like?
aiming for a cumulative 3,800 billion in operating cash flows over the 5-year period.
Wow, 3.8 trillion yen.
Yep, and a return on assets, ROA, of approximately 4.0%. They also want to bring that debt level down.
The net debt to EBITDA ratio.
Yeah, aiming for around 5 times in the medium term and then down to about 3.5 times in the longer term. Deleveraging is clearly a focus.
How are they planning to hit these, well, pretty ambitious goals?
A core element is what they call full participation management, really trying to boost employee engagement.
Getting everyone involved.
Exactly. They believe actively using those ROA and area management systems we talked about will be instrumental. driving efficiency, finding profit improvements everywhere,
And assets.
clearly focused on optimizing their existing asset base, getting more out of what they have, and accelerating their overall growth rate.
Makes sense. Now, for a company running railways, safety has got to be absolutely paramount. How does that fit into their future plans?
It's baked into everything. They state it's their absolute top priority, underpinning everything else.
Actions speak louder than words, though.
True. They launched a new safety plan just this April in 2024, and they have a group safety plan running to 2028. The focus is on foreseeing the unexpected, proactive risk mitigation,
Are they putting money behind that?
big time. They've planned a safety investment of approximately 1.3 trillion. That's a huge commitment.
Wow, okay. And what about the environment? Sustainability is massive now.
Also a major focus. They have their Zero Carbon Challenge 2050.
Net zero by 2050.
That's the goal.
Yep.
With interim targets too, a 50% CO2 emissions reduction by fiscal 2031.
Ambitious timeline. How?
Various measures, presumably renewables, efficiency gains, they're also actively pursuing a circular economy.
Circular economy, like recycling.
More than just recycling. Things like their UP Cycling Circular concept, trying to reuse materials in new ways, and rolling out more advanced recycle stations, reducing waste, promoting resource efficiency.
So wrapping this up, it really seems JR East is trying to navigate the future by, like, standing on two strong legs. Its core mobility strength,
Building on that foundation.
while strategically expanding into these lifestyle businesses, all underpinned by tech, financial discipline, safety, and sustainability.
That sums it up pretty well. They clearly understand they need to adapt. Changing demographics, changing societal needs. They can't just stand still.
Right.
They're leveraging their huge infrastructure footprint and their brand recognition to chase new growth and create value in different ways.
Yeah, this deep dive really shows a company with, incredibly deep roots, but one that's actively and strategically trying to shape its own future. It's not just sitting back.
Definitely not.
It really makes you think about the evolving role of these big transport companies. They're not just moving people anymore, are they?
No, they're becoming much more integral parts of daily life, the regional economies they serve.
It's fascinating to consider how a company so fundamental to Japan's infrastructure is innovating like this, balancing tradition and the future.
It is.
What might this tell us, maybe, about the future of other large, established infrastructure players around the world? How will they adapt? Something to think about.